Welcome, Monica and Ross, and thank you for joining my associates and I this morning at Green Tax LLP. We're here to discuss Geller Engineering Inc. and the tax issues raised. To provide some background, GEI is a boutique engineering firm owned by Monica Bing and Ross Geller, yourselves. GEI has operated as an S corporation since the company's inception 5 years ago. And now the real reason we're here is in light of the recent passing of the Tax Cuts and Job Act of 2017. Monica and Ross would like to revisit GEI's S corporation status. So, in response to this, Green Tax LLP has agreed to perform extensive tax research and calculations of both an S corporation and a C corporation taxes for 2018 in order to ultimately make a recommendation on the type of business entity that would best suit your company from a tax standpoint. Now, some background on the Tax Cuts and Job Act of 2017. It was signed into law on December 22nd, 2017, and the act is in effect for 2018 and beyond. Now, the most significant impact is related to corporations, where a new flat 21% corporate tax rate has been introduced. And there are several other impacts, but some that potentially will affect your company are the new deduction for pass-through entities such as S corporations. And this deduction is based on qualified business income, and we'll get more into the specifics in the tax calculations. So, in terms of an S corporation versus a C corporation, the biggest difference is really how the entities are taxed. Now, as I'm sure you're aware, for operating the last 5 years as an S corporation, they're pass-through entities, meaning they're taxed at the individual shareholder level. And the difference with a C corporation is that it's subject to what they call double taxation, meaning they're taxed both at the corporate level and personal income taxes paid on dividends at the shareholder level. And we will go into greater detail, and you'll be able to see this illustrated during the presentation of our C Corp and S Corp calculation.
C corporation is subject to double taxation. It taxes at the corporate level and personal income tax on dividends. Under the Tax Cut Job Act, there are lower rates that apply to individuals upon receipt of qualified dividends, and the reduction in corporate tax rate went from 35% to 21%. If GEI incorporated as a C corporation, the federal income tax liability would be $218,400. It calculates as the taxable income provided on GEI's income statement and multiply the new tax bracket of 21%. For the personal income tax of Monica and Charlie, we need first to calculate the adjusted gross income, which including the salary they earn, mutual fund investment they gain, and the qualified dividends they receive as a C Corp. It gives an adjustment gross income of $345,000. However, married joint filer can take $24,000 standard deduction during the 2018 tax return. Thus, the taxable income of Monica and Charlie is $321,000. After the taxable income, we needed to identify the tax paid by Monica and Charlie. Based on the IRC, a 15% rate to adjust net capital gain for married filing jointly between $72,000 and $479,000. Qualified dividends tax is taxed same as net capital gain, which is 15%. Monica and Charlie also surpassed the taxable threshold limit, which is $250,000. Thus, they're subject to a 3.8% tax on modified adjusted income. Last, Monica and Charlie's income tax would be $40,419 based on the tax rate of married jointly return for year of 2018. The tax liability of Monica and Charlie is $59,779 as a C corporation, and all the calculation is on the bottom of this page. For the personal income tax of Ross and Rachel at C corporation, the adjusted gross income of them gives a total of $57,000 since they only have qualified dividend received as a C corp and salary that Ross earned. They can also take $24,000 standard deduction as a married joint filer. Thus, the taxable income of Ross and Rachel is $33,000. Based on IRC 1J-5, Ross and Rachel's doesn't have to pay tax for dividend because their qualified dividend is less than $77,200. They do not face the 3.8% SERP tax because they are below the threshold amount. Therefore, they only have to pay an income tax of 10% on the remaining $13,000 taxable income, which leaves a total tax liability of $1,300.
So different with the double taxations for C corporation. S corporation can distribute the profit to shareholders, so the income will be taxed at the individual tax level. As mentioned in the previous slides, the Tax Cuts and Job Act of 2017 allows new deductions called 199A for 20% of qualified business income if total income is lower than $157,500 or $315,000 for married filing jointly. Income that exceeds those limits will get a deduction for the greater of 50% of the salaries or the total of 25% of the salaries and 2.5% of the unadjusted basic of qualified property. Next, we will introduce how X corporation tax at the shareholders level for GEI. So based on the background information, the total income for Monica will be $1,072,000, which is 80% of the $1,040,000 net income plus the $240,000 salaries. And then by including the $24,000 standard deduction, the total income will be $1,048,000 for Monica. And next slide, we will introduce the 199A deductions. Because Monica's income is higher than $315,000, she will get the 50% of the allocated salaries, which is $330,000 times 80%, and then times 50% to get the $132,000 deduction. And then we will minus the deductions from the total income in order to get the taxable income, which is $916,000. So based on the 2018 individual tax rate bracket, the income tax will be $278,299 for Monica. So beside the taxable income, we also need to consider the capital gains and investment taxes for the $25,000 that Monica got from the mutual fund investment. So by combining the income tax, capital gain tax, and net investment income tax, the total federal income tax liability will be $284,249 for Monica. So next for Ross. So based on Ross' background information, the total income for Ross will be $245,000, which is 20% of the net income plus the $37,000 salaries. And by including the standard deductions, the total income will be $221,000. Because Ross and Rachel's income is lower than the limit, Ross can get 20% deductions of the qualified business income. So it will be $40,800. So we will minus the deductions from the total income to get the taxable income, which is $180,200. Again, based on the 2018 individual tax rate bracket, the income tax will be $31,827 for Ross. As the result, the total tax liability for Monica and Ross will be $316,076 if GEI continue to operate as an S corporation.
After doing our calculation, as a group, we decided that it was better for Geller Engineering to switch to a C corporation. As a C corp, the company's total tax liability is only $279,479. If Monica and Ross wanted to remain an S corp, they would actually be overpaying by $36,597. If they wanted to pay the least amount of federal income taxes, then it would be in their best interest to switch to a C corporation. By making the switch, both Monica and Ross benefit. Monica's total tax liability goes from $284,249 to $59,779. By making this switch, she will save over $200,000. Ross will also save about $30,000 by switching to a C Corp. His total tax liability goes from $31,827 to $1,300. These savings are substantial and definitely worth making the switch. Not only are the savings worth making the switch, there are other advantages to a C corporation. The income tax rate is permanently fixed at 21% and will not change based on income. Another advantage to a C corporation is that this type of entity provides more security from lawsuits and more opportunities for shareholder growth, unlike an S corporation where it is capped at 100 shareholders. Finally, C corporations can receive benefits and lower tax rates if earnings are retained within the company.